Amid this increasingly volatile market, we're taking a deep dive this week into a number of sectors to help you find hidden opportunities for your portfolio. Today, we're serving up the food and restaurant industry. And joining us now with the word on the street on that sector, David Palmer of Evercore ISI. David, great to see you. Thanks so much for joining us. I want to get really straight into the stock picks. And Wendy's, you recently upgraded to buy. Why was that?
Well, it's been left behind. It's been an underperformer for a year to some degree that mystifies us because they've been executing pretty well. It's a small to mid-cap name. Many times when you're a GARPy stock within this mid zone, you're overlooked, and this company has been executing very well. Mid-single-digit comp grower. It's well protected from inflation, which, of course, as you know, is a big theme today. With the franchise business model, and it's doing a nice job of accelerating unit growth ahead, which should help it converge its valuation to the bigger players like Yum Brands, McDonald's, and QSR, which are 2 to 3 turns rich to it in an EBITDA multiple.
Are all the restaurants that rely on the franchise model, David, protected from inflation? Who do you look for when you see margin pressures?
Yeah, there's, each of these names, as I think you know, Sarah, they're all different in little ways. Like McDonald's is 98% franchised in the U.S., more like 92% franchised overseas. But the good news is the inflation overseas isn't as much. So that's what McDonald's has going for it. But it doesn't have the international emerging market kicker on the back end of this that a Yum Brands, for example, would have. That's a good news thing for Yum. In the case of Wendy's, they're really a domestic player, and they've been gaining share from players like Burger King in the U.S., and they're driving accelerating unit growth in the U.S., partly through some of these digital kitchens that they're going to be launching, which are going to be delivery-oriented. So this is really a U.S. story in the case of Wendy's. And you don't have to have very high expectations for this unit growth acceleration in the U.S. to make it worth your while at 15 times EBITDA compared to the other names at 18, 19 times EBITDA.
And David, quickly, let's touch on Hostess brands as well, which you've had for buy for longer, but you have been upgrading your estimates for.
Yeah, Hostess is a small, sweet baked goods company, and they've been better managed in recent years. And you can see the stock beginning to act better. I think the story is getting out. Their top line growth has been outstanding. There's a lot of upside to consensus numbers still into the second half of the year. They have new products like baby buns and crispy minis. And the fact is, this thing trades around 12 times EBITDA. If it were a healthy snack company, it'd be trading at 20 times. And even some of its larger sweet snack peers like Hershey and Mondelez are trading in the high teens. So possibly you could dream some really big dreams in terms of valuation upside here, pushing this through $20. So we like Hostess.